Welcome to Morphic Labs, and today we are going to be discussing Kagi charts and volatility based bars. But before we get into that, do me a favor, hit the subscribe button if you want to keep up with more content like this. If you're interested in getting your hands on this resource, the link's in the description. If you're interested in getting your hands on this advanced resource, check out my Discord and I'll walk you through the qualifications and applications. Now, let's get into it. Now, what is a Kagi chart? Kagi charts change direction only when price reverses by a specified amount, using variable line thickness to indicate trend strength. Here's the formal description. Reversal amount equals R, which is percentage or absolute. Line continues in current direction until reversal threshold is met. Thick line, a yang, is defined as when close exceeds previous high. A thin line, a yin, is defined as when close falls below previous low. Now, when do you use this type of aggregation? Supply and demand analysis, long-term trend identification, key level breakout detection, Japanese technical analysis methods. What are the advantages of this type of aggregation? Emphasizes significant price movements. Line thickness provides additional signal. Reduces noise from minor fluctuations. Focuses on supply-demand dynamics. Now, let's focus on the disadvantages. Reversal parameter is subjective. No volume or time information. Less useful for short-term trading. Requires historical context for interpretation. Now, let's get into the code. We're going to be using my 1 minute VIX tick data. It's from 2025, 12/22 up until (2026) 01/05. Now, before we get into it, let's look at a picture that helps us interpret these aggregations. Now, the first one, Kagi chart interpretation. The market action column has trend continuation, minor noise, directional change, bullish breakout, bearish breakout. Another column is logic. The other one is resulting visual, and the last one, and the most important, is interpretation. Now, when the trend continues, the logic price moves without reversing by R, right? Extending vertical line. The interpretation, current trend remains intact, noise filter. Now, let's look at the code, because when you look at the code, it will make more sense. I'm going to be using a reversal threshold of 0.15. Okay. So here is our visual. As you can see, let me put this interpretation, let me make it a little bit smaller. Okay. Now, as you can see, every time the yin just started going down and down and down and down and down, what you see is price moves without reversing by R, right? And then it extends vertically. And then the interpretation is current trend remains intact, noise filtered, but minor noise. Price moves against trend by less than R. There's no change, right? Movement ignored. Another market action, directional change. Price reverses by R or more. Horizontal plus vertical line reversal triggered. And as you can see, there's essentially all these ups and downs, ups and downs, ups and downs. Those are the reversal or the close condition being fulfilled. Now, the bullish breakout, yin exceeds previous high, thick line. As you can see, sorry, as you can see over here around the 2000 index, the Kagi chart changed from yin to yang, right? And then around the 2000 and maybe 2005, maybe 2006 index, as you can see, it went from yang to yin, right? And essentially, the advantages is the emphasis of significant price movements, because when you're looking at a Kagi chart, just by looking at it, you can tell when essentially the dynamics or the structure of the overall market changed, right? Because from say the 0th index up until the 2000th index, you just had a straight path down, right? And then around the 2500th index, you had a straight path going up just for a little, and then it went back into yin, and then it changed again around the 3000th index, and it became a yang, right? Now, what I'm going to do is I'm going to change the reversal amount, right? And I'm going to make it essentially smaller. So instead of 0.15, we'll do something like 0.01. Let me just display it. Now, when you look at it now, the yin and yang are far, far more granular and more incremental, right? There's a lot more yins and yangs compared to the previous chart. And when you're looking at this, it might look a little bit chaotic, but with the right function or statistical models, you can extract fairly useful information from this type of aggregation. Now, let's focus on a different type of aggregation, which is going to be volatility based aggregation. Now, what is the formal description of volatility based bars? These bars aggregate trades until the realized volatility or standard deviation of returns reaches a target level. Here's the formal description. Log returns defined as R sub I equals natural log of P sub I over P sub I minus 1. Realized volatility is defined as sigma sub realized equals the square root of 1 over n minus 1 times the sum of R sub 1 minus the mean squared from I equals 1 up until n. The bar close condition is realized when sigma sub realized is greater than or equal than sigma sub target. When do you use this type of aggregation? Options trading and volatility strategies, risk adjusted position sizing, volatility regime detection, cross asset volatility comparison, stress testing and scenario analysis. What are the advantages of this type of aggregation? Consistent risk representation per bar, natural normalization across assets, directly relevant for options pricing, filters low volatility noise periods, adapts to changing market conditions. Disadvantages: requires sufficient data points for stable estimate. Target volatility selection is subjective, computationally intensive, may create very long bars in low vol regimes. Overlapping windows complicate analysis. Now, let's get into the code. Okay, so I'm going to plot just the first 100 indexes so I can get a geometric intuition for the aggregation. And essentially what you see from this is the target has to be very, very small. And I mean very small, because price, when it moves, usually doesn't move in extremely dramatic ways. So your target has to be small enough to capture that. Now, what I'm going to do is I just want to adjust the plot and remove the size essentially, because it's making it unnecessarily framed. Okay, just want to see if okay, looks way better now. Now, this is only 100 entries, right? It's not really enough to justify the aggregation. Let me make this smaller just to see something. Okay, I mean bigger. Okay, let's make it very small now. 0.0001. And as you can see, the first 100 indexes show about, I don't know the number of volatility bars, but what you can see from this visual is that the smaller the window size, the higher the volatility, right? And the higher the window size, the smaller the volatility. So when you look at this window size over here, it's a window size of 4. But this one, the next one, is a window size of about 2, right? So essentially from this window to that window, price was actually more volatile because they had a smaller window size, right? Now let's go into our interpretation. Now, how do you interpret this? Market state column has quiet market, volatile market, neutral market, extreme calm. Log returns, Asabai has small, stable, large, erratic, moderate, mixed. Realized volatility as below target, long duration to reach target, hits target fast, gradually reaching target, very low, potentially never hitting target. And window size, large, long, small, short, moderate, average, width, very large, infinite. Now, when we look at our aggregation here and you look back at our interpretations, what you'll see is these long bars indicate quiet moments in the market. But let me slow down a little bit. I'm getting ahead of myself. This is only 100 entries, right? Let's try the entire data set. Now it's be just like I suspected, very noisy. But as you can see, just focusing on, okay, let me do this. Okay, as you can see, just focusing on the window size, there's periods of high window size, low window size, indicating high and low volatility. And when you look at the volatility bars, they're spread out across the price space, right? So let's look at this interpretation. Quiet markets have small, stable returns, right? They also have a long duration to reach the target, i.e., sigma sub target takes longer to reach. Window size ticks are usually very long and large for quiet markets, right? So when you look at this specific window over here, around maybe 2001, no, 2000. I'm not sure the exact number, but if I had to guess, maybe 2.1, 2.2. But the one my mouse is pointing at is essentially connected to this part where, as you can see, volatility bars weren't really that explicit around this period of the window size. And if we can look much closer, which I'm not going to do now, I'll do that in some future video or on the Discord if you want to join. But what you can see is that the market's volatility is very stochastically distributed, right? It's hard to predict. There probably is some interesting statistical properties there, but all in all, it's very hard to predict, right? Back to the interpretation. Volatile markets have large erratic returns, hits target fast, short duration to reach target, small short bars. And as you can see, we have a lot of small bars, right? Indicating that the market was extremely volatile. Back to the interpretation. Neutral markets have moderate mixed returns, right? Gradually reaching target, moderate average width. So we're talking about window bars that are not too small, but also not too big, right? And then we have extreme calm, near zero diluted, where essentially very low volatility, right? And it takes very long, if not forever, for those window bars to be closed. Now, when you look at this as it is, it's insightful, it's interesting, but the really interesting part happens when you start trying to build the models and strategies from this type of aggregation, because volatility aggregation has to be one of my favorites, one of my most, I would say, intuitive, at least for me. The aggregation is very intuitive because it captures a very fundamental feature of markets, which is volatility. But I'm about it for today. If you're interested in getting your hands on this market microstructure and trading systems course, is free. The link's in the description, or join my Discord and get my advanced market aggregation course plus the microstructure course. It's also free. You just have to jump over some hoops, some qualifications, and you'll have access. And that's about it. I'm out. Bye.